and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, how to crash-proof your investments? Is it even possible? If yes, what can you do to ensure your hard-earned invested money stays safe? To tell us that and much more, I'm joined by Dhirendra Kumar, CEO Value Research. Welcome, Dhirendra.
Thank you.
Media reports are full of market crash predictions in the near future because of multiple reasons. What's your take on it, Dhirendra? Do you see a market crash coming?
We don't know, and don't trust anybody who is predicting anything, because nobody knows. All the past big swift moves that we have seen in the market was not predicted beforehand, and hindsight is always perfect. After something has happened, we go about justifying it that it was coming or it was imminent, or there were all variables pointing to it. Market is a very unusual cocktail mix of too many variables, and you don't know what happens, what is driving the market in the short run. We saw last year that the market did go down for a brief period of time, and the way it made a comeback, despite all the difficulties, all the concerns that we had about the market, that continues. But the market has made a comeback and has actually kept roaring despite all the concerns. So err on the side of caution, prepare for it if there is a need to. But if you're investing for the long run, if you are unlikely to need the money in the short run, don't even bother about the predictions. Just keep your SIPs on, keep your accumulation on, and don't even come to Value Research online to look at the portfolio values every day. Look at it every month or so, just for general knowledge to enhance your understanding. Nothing beyond that, not in terms of acting. There are some people who should work around it, who should look at it very proactively. And those people, they are I can actually classify them, the kind of people who should worry about it. They should prepare, and they should prepare proactively. Somebody who is approaching retirement, or somebody who is closer to the goal for which he was investing. I think those people, they need to really take a stock, because market is not predictable in the short run. And if your plans are going to depend on that, your investment values today, and when you need it and when you go to realize it and the market has come down dramatically, it will be quite unnerving. It will be scary. It will be disappointing.
I remember a lot of investors were taken aback during the last crash, specifically those who were nearing their financial goals. So what kind of steps or strategy would you suggest to avoid a repeat of that episode? How do you think investors can ensure a crash-proof withdrawal?
One is that, it is not really possible to completely crash-proof your investments. Investments, when the markets go down, everything goes down. Now it's only a matter of magnitude. Something falls less, something falls far more dramatically. Concentrated portfolios falls so much more. So you have to really deal with it, and your personal circumstances should be the primary guide, the way you should prepare yourself, which is, for example, I would broadly like to give guideline for three kind of investors. One is the person who has recently started, last 1.5, 2 years, somebody got started with his SIP or his investment, and he has been lucky. The market went down, but despite that, the values are up, and the values are up 30-40%. So those investors, they might panic if falls and it actually prevails at the lower level. They need to really learn and understand, and they need to coach themselves. They have to find a coach who will actually tell them how to behave when the market falls freely in a period. Then the other, there are other set of investors who should really worry about it, and they should prepare for it, and they should prepare very methodically about it. One is an investor who is going to need the money, and he has come to achieve his goal, say, and a non-negotiable, even for a consumption. You are planning to buy your car, and the money has appreciated to a point where you can go ahead and buy it. And this is, but you're still, getting carried by the market because it's going up every day, getting a little greedy. Maybe it's about time, take your money out and go and consume that money for whatever you're planning to. The other is, somebody who was planning to, it's for a non-negotiable goal, preparing for your child's education, and that is 6 months away. For those goals, I would say that, you have to really get proactive, because you'll be in real distress if you don't take your money out, and then you will be dependent on the state of the market for those things. That is impractical. That is assuming too much risk. That is banking too much in the market. So as we keep saying, that invest regularly over a period of time, disinvest regularly over a period of time, and don't wait for the market to, don't depend on the market to realize your money. So, for example, if you need, if the accumulation is for your child's education, take the first year's tuition fee and put it in a fixed income. You would have insulated, and you have bought time. You will have 2 years time. Then, in another 6 months, if market doesn't fall, take another year's tuition fee. And if it falls, you will still have time to wait. You will have patience. So you basically, the idea should be to buy time, to prepare yourself in a manner that you don't panic, because you panic only when you don't have time. Third is, when your thinking undergoes a change, you become conservative, you start worrying about things much more. When you realize that, okay, you're about to retire, and your income will come to a standstill, you will stop earning, and then you have to depend on your investments for generating income for your day-to-day living. And that is something which is a big change in your, because you have worked for 20-30 years, accumulated, and then all of it is in market, and you need to really prepare. You need to spend some time learning about it. You need to prepare very methodically about it. Maybe the simplest way could be, uh, having 3 years income requirement in fixed income. Rest of the money can be conservatively, allocated, maybe half into equity, half into debt, but 3 years income over and above that should be in fixed income, so that you can once again buy time. You will have 3 more years, and you will not panic again. You will be comfortable if the market falls, because it's not going to really disrupt your life.
So, as for what you said, time here is of utmost importance. You said that one should invest over a period of time, one should disinvest over a period of time. So, can you elaborate a bit on that? What is the ideal duration across which withdrawals could be spread?
Uh, Ideal is entirely a function of your circumstances. If you are likely to need the money over the next 1 year, then maybe in the next 6 months, the part of money which you require in the next after 1 year, over the next 6 months, realize it methodically, month after month. You need 5 lakh rupees, maybe take out 40,000 rupees every month and put it in fixed income. You will not be dependent on the state of the market then. But what you are doing is, you are also reducing the risk of the whole money going down in value, and then waiting for the last day. As we keep saying, that eliminate the possibility of catching a market high. Eliminate the possibility of suffering from a market low when you need your money most, and that is crucial. So that is one. The other is, as I was saying, that for a retiree, somebody who is about to retire, and you've accumulated, and then you realize that all your money is in equity, and it goes down by 40% in a span of 1 month, and that is also the time when you are retiring, or you are about to retire. That will be very unnerving. That is why as I was saying, that if you're going to depend on the income from your investment, you need to go very proactively. There are many retirees who are unlikely to need the income from their investment. It is still there, even though you are retiring, your money is for the long term. You are unlikely to need, the money is meant for leaving another state for your children. And so from that point of view, maybe make it a little conservative, make it a third of money into fixed income, so that when the market crumbles, your investment don't crumble as badly.
All right. And do you think aggressive hybrid funds can play a role here, if they can help the investors?
Yes, that is one. It is the simplest vehicle. These funds typically invest 20 to 35% into fixed income, and by making one investment, you are able to embed periodic rebalancing in your investments. When markets fall dramatically, these funds fall less, and they are also able to reasonably participate in the rise. And of course, they may not, one can say that they don't rise as rapidly or as much as an all equity fund, but that's fine, because it's more important to benefit from the equity story in a methodical way than losing your sleep over it.
All right, now time to move on to our viewers' questions. And the first one comes in from Ajit Kulkarni. He says he'll be retiring in less than a year and he's been coming across crash predictions quite often. So, will it be right for him to liquidate his equity investments and shift them to gold and debt mutual funds?
Mr. Kulkarni need to really work hard on this. His plan of action should be dependent on two things. One is that will he require income from his investment, or he has some other revenue stream, whether it be pension or rental income or any such thing. If he's going to depend on income from his investment, he needs to prepare very aggressively, which is have at least 3 years of income requirement in a fixed income to begin with, and the remaining money that should be equally into equity and debt. Another question which is asking is that, should he be investing in gold? I don't think one should be investing in gold, because the understanding that we have is that gold is, gold is not a productive asset. Yes, it is a store of value, uh, but in the short run, it also goes down. And it is unlike fixed income, which generally doesn't go down in value. It might, fixed income or debt fund or bond fixed deposit, they can generate low return. They can have low interest rate or coupon on them, but they don't go down in value. Of course, one can be exposed to credit risk of unusual kind when you can lose money, but generally not. That is not the idea. That is not the design of fixed income. Gold can go up and down, and many times it has gone up and down as well. If you look at last 1 year, it is down about 2.5%. So if one would have invested 1 year ago, you will be in for a great disappointment. So yes, it turns out to be, so gold is not an option. Consider fixed income and equity, and so this is plan one. If you are unlikely to need the money if you are unlikely to need the money to generate income for you, then have a conservative allocation to your convenience. Half of it in equity, half of it in debt, and that way, and periodically rebalance it. Periodically rebalancing it will actually keep you will keep your risk in check. And this might it's much easier said, but it's very difficult to do, because this amounts to taking money out from something which is going up in value, and it might amount to an opportunity loss, or you might have a feeling of opportunity loss when you move your money from equity to debt in a marginal way, and after that it keeps going up. But what you are doing is basically building shock absorbers. You are managing, you are just preparing things in a manner so that you don't lose your sleep. Not losing your sleep should be an important objective for every investor, because when you lose your sleep, you lose your sleep when you have less time. You need the money in a month's time, and the value of your investment has gone down. It might be very depressing. So not losing sleep, having having enough time for your investment, for your equity investment, and not investing your equity for the short run. I think these are basic rules which you should never negotiate. And more importantly, keeping it diversified, so because we don't know what works very well when.
Now, Chanda Basu Malik wants to know if she should exit from banking and PSU fund in view of inflation and probable interest rate hike.
The concern is, valid. Everybody is thinking that because inflation is going up, so interest rates will also go up. Interest rate generally follows inflation, and but RBI governor last week said that it is an unusual year, and this is not like any other year, because interest rates will go up simply because inflation is going up. Inflation has gone up, but he still has a responsibility of reviving business confidence, reviving credit growth if at all it is possible, and for that he's going to keep the interest rates low. So I'm not hopeful. I would bank on his statement. Uh, but that said, so for that reason, you should not exit your investments here. But generally speaking, fixed income, the return from fixed income has come down so sharply and remains low that you have to settle with that. Of course, it is ruled out that you will actually see any capital loss because interest rates will go up. But even otherwise, but on the other side, on the other hand, I think interest rates are likely to remain low, and the return from these funds will continue to remain low.
Okay, 67-year-old PC Garg has a corpus of around 2 crore rupees. Around 65% of it is invested in equity funds, 20% in fixed deposits, and the remaining in debt mutual funds. So he wants to know if he should change the allocation to equity. His expenses are met from pension and rental income, he says.
Yeah, Mr. Garg is very lucky that this is an investment which he can see it grow, and he should work towards making, configuring his investment in such a manner that his regret is low if markets come down. So I would say that at all times he should keep it 50% into equity, whether it be through 50% through equity in equity and 50% into fixed income, whether it be through fixed deposits or through debt funds. And from that standpoint, 65% in equity today, he should reduce it to to an extent that the rebalance after realizing that money, a part of the equity money, his allocation will become 50% equity and 50% debt. And I think it is also about time that he should frame a rule for himself that he should move money from equity or debt from equity to debt or from debt to equity. If there is a more than 10% change in the allocation, which means 50 becomes 55, he should continue, and crossing 55, he should rebalance, or likewise 50 becoming 45, he should move money to equity, and lower than 45, he should rebalance. So having a 10% margin so that he's able to ride any the movement in any direction, because sometimes equity will go up, sometimes equity will go down, and having this 50% allocation to equity also keep it very simple. And I think it will enhance his return quite substantially if he's disciplined about it.
Now, Ellen Jen asks, what factors should an investor check before and after investing in a debt mutual fund scheme?
Before investing in a fund, you should try and match the fund's orientation matching with your goals. If you are investing for few days, and if you are investing in a fund which is long maturity papers, and it is you are just don't get carried by the recent returns of the fund, that may be that may mislead you in the wrong direction. So choose the appropriate category. That is crucial. And once you have invested in the fund, keep an eye on the credit quality, and you come to Value Research Online, look for that funds page, go to the portfolio section and see how much of it is in sovereign and triple A. And if lower than that, or triple B and double A minus, those things are actually increasing, you have reason to worry, because normally they are investable grade in securities, they are investable grade bonds, but in bad times they suffer. And many a times we have seen that most of the debt crisis, they come when you least expect it, they come as a big surprise. So keep an eye on the credit quality, that's about it. And before investing, keep an eye, choose the right kind, so that you are not disappointed and you are not in for a surprise.
All right, Payal Choksi wants to know, amid uncertainties, should investors in the age group of 45 to 60 reassess their allocation? Also, should they be considering non-participating, non-linked saving schemes sold by insurance companies for regular income?
For somebody between 45 to 60, this is a broad range. It depends on how far or close you are to your retirement. So if you're close to your retirement, you should generally tilt towards fixed income in a manner that your income requirements are met. But it entirely depends. It depends on your situation, your circumstances. Will you be depending on your investment for income? Then you need to prepare differently. If you are not going to depend on these investments, then you need to prepare a little more liberally. You can assume, you can have a larger allocation to equity because you don't have to worry about the worth of it all the time. So that's one. Evaluate your situation and your needs more objectively and plan things accordingly. Uh, and should you be looking for an insurance linked, non-linked savings scheme sold by insurance companies? Generally, no, because these investments, they combine insurance and investment and they generate income. For any thoughtful investor, one should have, an investment in a low-cost debt fund and a equity fund, and even there a low-cost equity fund, and rebalance it, and you will have a superior outcome resulting from it. Unless you're looking for some kind of, you're very scared and you just want a guaranteed income from any of those plans, but any guarantee comes with a cost. It will lower your return. So thoughtful investors should not go there. So my suggestion is plan your allocation depending on your situation, and avoid any insurance linked investments.
Now, the next query has been sent in by Kaushik Chatterjee, and he asks, would you suggest investing in a gold fund through SIP for the next 5 years? What are the other options, he wants to know?
Generally speaking, one should not be investing in gold funds. One should not be making long-term investment in gold because I think it is a store of value. But I don't think it is a appreciating capital or it is a productive capital, because when you invest in bonds or fixed income of any kind, you are lending money to somebody and he is putting it to productive use and giving you some kind of a short return or an indicative return or a predictable return. When you are investing in equity, you are taking a proportionate ownership and you are entitled to the proportionate, the ownership benefit, entitlement to the earnings, entitlement to the dividends. When you invest in gold, it just sits there. It's not a productive asset. Uh, so generally, long-term investment is avoidable, but just in case, but it's an asset which has the oldest history. It has the longest legacy. So, and gold has its own charm. But I think the finest form of gold ownership is the sovereign gold bonds, which is available to Indian investors, because there are many ways in which you own gold. One is jewelry. You enjoy it, you show it to people, and then you spend money there. But then the making charges, it's not an investment. I think it's a consumption, given the cost of converting gold into a jewelry and reversal of it. Likewise, gold bars and coins and other things will also, I think it's easy to buy. I don't know how easy it is to sell and realize the money. Gold ETFs, it comes with a cost. It has an expense ratio. And the gold funds, because you can't have a demat account or the ease of buying it like a mutual fund, those funds in turn own these gold ETFs. They buy the gold ETF, and it has a slightly higher cost than the gold ETF. The gold funds have a higher cost than the gold ETF because they own gold ETFs. These sovereign gold bonds, this is an interesting option for Indian investors, and it is easy to buy. Easy to buy because government issues it every now and then. So you can buy it directly from the government through a bank, then when and 3-4 times in a year it is being issued, and it is also available in the secondary market for an individual investor. And there it is easy to buy because today you have many online brokers who provide you almost frictionless ability to buy these sovereign gold bonds. And these sovereign gold bonds, they not only give you the return of gold, but they give you 2.5% annual return over and above the gold prices. The gold prices might depreciate or appreciate, so you will be entitled to all the returns. Over and above that, 2.5% return annually makes it very compelling. Over and above this, if you buy it directly from the government when it is issued, and hold it for the entire term, which is 8 years term for which it is issued, then all the returns also become tax-free if you don't sell in between. So for Indian investors, the finest form of gold ownership is sovereign gold bonds.
Rajesh has asked for your investment advice to a newbie considering the current market scenario.
Markets are like this only. They are always, they are scary, or they have gotten into a stage where it looks like they are ready to crumble, or you have missed the bus. So to begin with, uh, plan how much you can invest, how much you can save every month, and keep doing it for the first 3 years. And don't look at the investment value. That is the only way to start. Because if you keep waiting to time your entry into the market when it will crumble, it is very difficult to do it, because when it starts falling, then then you keep waiting for the fall to settle down to a level where you can start investing, and you never get that time. So uh, get out of this mental framework, get methodical about it, and start investing, and stop looking at it every day for in the initial phase of your investment.
All right, now SK Sharma asks, are mutual fund schemes liable to pay capital gains tax on selling and purchasing equity debt securities?
No, that is one of the biggest advantage of investing in mutual fund or through mutual fund. Mutual fund is a tax-free way, is not liable to pay any taxes. Any taxes on investment is to be paid by the investors. So when you invest in an equity fund, you sell before 1 year, within 1 year of your investment, all the gains are liable to short-term capital gains tax, which is 15%. You hold it for 10 years, you have to pay 10% of your total gains, and that's about it. So an investor pays the gains here, pays the taxes here. In case of fixed income, the fund company doesn't pay any tax on the interest it gets or any realized gains, even on fixed income investment. You pay the taxes, and the rules for fixed income is that you hold it for less than 3 years. All the income generated from a fixed income fund is treated as your income and taxed accordingly, depending on if you fall in the 5%, 10%, 20%, or 30% tax bracket. If you hold it for 3 years and more, it will be indexed. So indexation is, every year in the budget, the government discloses the cost inflation index, whatever, and adjusting your investment for that. And post indexation, beyond the inflation, whatever is your gain, you are liable to pay 20% tax flat after the index cost. So the rules are pretty simple. Mutual funds don't pay taxes, and you pay taxes depending on your tax rates, or depending on the investment that you're making, equity or debt.
Amit Jyoti Lakar wants to know, what will be the impact on debt funds if the stock market crashes?
There won't be much of an impact on the debt market or debt funds if equity market crashes, equity funds or equity market crashes, simply because the dynamics of the debt fund or the on the fixed income market is very different. What actually has a bearing on the fixed income or the debt fund is the general state of the economy and the inflation rates. If inflation goes up, interest rates go up, and that has a bearing on the debt funds. Bonds are badly hit if interest rates go up. Bonds benefit if interest rates go down, and so that's one. The other is if the credit quality improves or deteriorates. If a lot of companies are in difficulty and they are facing problem in terms of poor economic conditions, their poor leads to their poor financial health, and they are unable to honor very well all their debt commitments in terms of repayment of principal and interest on time. That will lead to lowering of credit quality, credit rating, and a default will lead to that part of the money getting affected. So credit quality has a bearing, interest rate has a bearing, and the third thing is the liquidity. Liquidity in the system uh, reduces the charm of money in the short run. So these are the three broad variables. There is one connection between equity and debt market, which is when interest rates are low, it is generally considered to be good for the equity market, simply because when you don't get any meaningful return. So there is a connection between uh, debt market and equity market, that equity becomes attractive because people are willing to take chances. When you get very lower return for not assuming chances, you think that it is worthwhile to take equity risk. Your equity, even if you get little more return than fixed, or marginally higher return than fixed income, that is worthwhile, because otherwise you are squeezed of returns on from your investment. So there is a relationship between equity and debt, but not directly.
Now, today's last question has been sent in by Santosh Bhosle. He wants to know if you would suggest shifting from all regular plans to direct plans.
If you take all your investment decisions yourself, if you don't seek the help of an advisor, if your advisor is not helping you coach, or you don't bank on him for coaching you, because I think that is a sign of a good advisor, that is a very valuable service. If you are not using any of these, and if you think that you are confident, or you're capable, or you're equipped enough to make your own choice, you will have the discipline, you won't need a hand holding, then you should go for a direct plan. And then comes the mechanics of doing it. If you are switching from regular plan to the direct plan, you should keep in mind two things. One is, of course, these variables, that you don't need the hand holding and you can do things yourself. Then comes, you should be you should look at the tax implication of moving your money from regular to direct, because it is treated as, tax wise, it is treated as a redemption and a new purchase. So that will have a bearing on that. All the gains that you will realize will get reduced by 10%. Your 10% of your gains will go by way of taxes, and then the money will start working from here on. The other is, all the money made within the last 1 year, equity investments particularly, they will be subject to the exit load. So be wary of that. Plan things accordingly.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you, Ruchira.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.